Let's welcome in Milind Agrawal, Fund Manager. He tracks the banking space closely, Fund Manager with SBI Mutual Fund. Milind, thanks for taking out time for us. Let's start with the banking names. How do you want to take it up with, in terms of larger ones first, the middle ones second, or can you just summarize the PSU banks which have declared numbers, the likes of SBI and some of the others? What is your analysis on banking and NBFC so far?
Sure. Thank you so much. So over the last couple of weeks, quite a few private sector banks have reported numbers. And what we've seen is that we're seeing an environment where not just the credit growth is improving, but we're also seeing margin improvement tailwinds. And that is not unusual because typically in the early stages of an interest rate hiking cycle, what we see is that because the banks carry a fairly sizable proportion of CASA, which is largely fixed rate in nature, and the asset book today is a lot more variable rate in nature. And so we've seen that the deposit repricing comes in with a lag, but the asset repricing has sort of led to deposit repricing. And so what we're seeing is that not just credit growth has been strong, but it's also been aided by strong margins for most of the private sector banks that have reported so far. If we add to that another element which is very important, which is the asset quality numbers. So in the early stages of COVID, there were worries as to how retail and corporate as well as SME asset quality would pan out. But over the last couple of years, what we've seen is a very, very strong performance by all three segments of the industry. And hence, if you look at the slippage or the asset quality data for most of the banks that have reported so far, it has been lower than the trend levels and it's been quite strong. So the confluence of all these things, stronger credit growth, improvement in margins, as well as a strong asset quality outlook, has led to very strong profitability for most of the private sector banks. And if you look at the return metrics for private sector banks, for most of them, they are ahead of their long period averages. And so we believe that the banking sector is in a good space right now. What we also need to watch out for is that incrementally every other day we hear about one or the other bank hiking the deposit rates. At the system level, we are now sitting at a loan to deposit ratio, which is touching 80s, it's in the mid 80s. And so as banks find more and more avenues for growth, they will have to find a way to fund this growth as well. And so in that context, given that the liquidity at the system level has largely been absorbed, we expect the pace of deposit rate hikes to accelerate over the next 6 to 9 months. That is already underway. And so we might see another quarter of margin improvement for a large part of the banking system, but over the next 12 to 18 months, we might see a normalization in terms of margins for the banking sector as a whole. But broadly, the earnings outlook for the sector continues to be very strong.
Sure. So, Milind, going by that prognosis, I wanted to understand where is it that you've placed your overweight or neutral or a fresh buy rating within the banks? Because what one is seeing is that, value may emerge now within an IndusInd and an Axis, but some of these smaller PSUs as well, market clearly is finding some matter in them.
Sure. So, without sort of talking in terms of the specifics of our individual banks, fundamentally we've been positive on the larger private sector banks that have a very strong deposits franchise and that have delivered strong asset quality performance over a long period of time. So our fundamentally positive view continues to be in favor of the larger private sector banks and select PSU banks. In terms of some of the PSU banking space, it's interesting that you touched upon that point. So the PSU banks have had a fairly strong run over the last year, and it's not without merit because if we see that performance on both credit growth as well as asset quality, it has been extremely strong. And what we're seeing now is that because the capital levels that these banks have accumulated over the years, the coverage on these stressed assets is fairly high. They have liquidity on the balance sheet, and they also have capital to grow. So all of these three things put together essentially mean that even the smaller to mid-sized PSU banks today are in a much comfortable position versus where they were a couple of years back. And so we've seen an environment where the return metrics for the smaller PSU banks are also in the low to mid-field, and we expect them to at least hold on to these levels in the foreseeable future.
Right. You think the delta will be made in smaller banks? I mean, where the book size is around 1.5 lakh crore and the potential is to become a 5 lakh crore over the next 6-7 years. Is that what you're trying to play? I mean, that's the best time when HDFC saw its best return, or SBI saw its best returns, or any of the other, larger banks like ICICI saw its best returns. How would you essentially play the theme? You buy smaller book size, expectation of higher ones, or you play the higher ones who can raise funds easily, manage any, issues coming up with deposit, and then probably wait for them to grow?
So here, broadly our view is that scale has its advantages. And when we look at some of the larger banks that have a branch network of, let's say, 4,000, 5,000, 6,000, in some cases, some of these banks have stated targets of doubling these branch networks. So what these larger banks have is not just a pan-India presence, but also a very strong brand franchise. And, globally, if you look at the other larger markets, whether it is some of the emerging markets or the developed markets, we typically always see a consolidation in favor of the larger entities. And while there are smaller pockets where we find interesting opportunities even within the banking space, but broadly, if I had to summarize our view, we believe the larger banks that have a demonstrated ability and continue to do well with a very strong brand name and a distribution will be market share gainers even over the medium to long term. But not to say that there might not be opportunities in the smaller banking space as well.
Milind, do you look at the NBFC pack also closely?
Yes.
So when we talk ex a Bajaj Finance, since 2018, every NBFC has had, some of the other issue ex a Bajaj and a HDFC in terms of their liability side, managing their assets. You think some of them have overcome that, and that's the space to watch out for in the NBFC pack because margins over there are substantially better?
So, NBFCs are sort of not homogeneous in that sense. They are sort of each NBFC caters to a different market, operates in a different segment. So, there is a vehicle finance NBFC sector, there are gold finance companies, there are microfinance companies. So what we've seen is that NBFCs fundamentally cater to a borrower which is a lot less catered to by the traditional banks because of the reach and because of the credit profile. And because of that customer profile, NBFCs saw a slightly larger hit on the asset quality during the last 2 years of COVID. But if you look at the last couple of quarters of data and the fact that these NBFCs today are carrying fairly reasonable capital buffers, we are obviously positive in terms of the asset quality outlook. But one thing to obviously watch out for is that for the NBFCs as well, the last couple of years have seen a tailwind in terms of the margin profile because the wholesale borrowing costs for NBFCs were fairly low. So going forward, what we see is that while asset growth is expected to be strong, there might be margin pressures and this might lead to slightly more moderate numbers on net interest income growth. But on asset quality, we believe a large part of these stress segments, whether it is vehicle finance or it is microfinance, these have largely weathered out the storm fairly well. And so the next couple of years, we believe NBFCs as a bank will do well. Obviously, we don't take a basket approach to investing. Whenever we analyze stocks within a sector, we obviously are stock specific in that sense. And so we typically try and find opportunities where the managements have demonstrated abilities to generate very strong returns for long periods of time. But there are certainly opportunities within subsectors in the NBFC space as well.
Okay, Milind, great to have you on the show. Thank you so much for taking the time out and helping us analyze what the construct of the banking sector is looking like right now, and of course NBFCs as well. Okay, that's the word coming in from Milind Agrawal from SBI Mutual Fund. Just quickly get your status check on what the market is